So today is Thursday, July 4th, and markets are closed today, but I'm going to show you two ways to find stocks, options specifically, to trade. So the first is the Option Alpha Screener. If you're not a member, I don't know if you can view it without being a member. I think you have to have a premium subscription, but anyways, this is a sampling of it. He gives you the recommended strategies. So GLD has pretty much the highest IV rank of any of the stocks right now. And the reason he suggests a straddle, a strangle, or an iron butterfly is they all take advantage of the high implied volatility that is kind of at historic highs right now for GLD. So think of an iron butterfly as essentially the same thing as straddle, just with closing wings on the other side. So it's not unlimited risk. It's essentially the same thing as a straddle. So a call and a put at the same strike price, but that, if you're selling those two together, that's basically unlimited risk. What the iron butterfly adds are two long positions on the opposite sides. So in between your short call and short put, you have a long call and a long put, and that caps your potential losses. So that's useful if you have non-tier 3 options trading where you can't just go pure naked. It also frees up a lot of capital because you have to set aside quite a bit amount of margin or cash if you're doing just a pure naked strategy like a naked straddle or a naked strangle. The strangle is a little safer. If you're doing it naked, then you could sell the naked call at the 20 delta, sell the naked put at the 20 delta. That's a little safer because with a straddle, of course the stock is going to move, but you're just taking advantage of the fact that implied volatility is the most important thing. So you don't care which way the stock moves, you're just playing the fact that implied volatility is so high and it's going to likely mean revert, and that will put one of the positions, the call or the put, out of the money. It'll degrade in value, and then you'll overall net a profit. That's the theory. Usually works, doesn't always. I do prefer strangles over straddles because you could sell those every week, and let's say your Tesla's at 240, so you could sell the 260 call and the 220 put, and as long as Tesla stays within that 40-point margin every day that goes by, assuming everything else stays the same, implied volatility, all that, every day that goes by, you pocket a little bit more until you eventually keep 100% of the profit. As long as Tesla closes anywhere in between those two strike prices, which is a pretty broad range of 40 points, you're good. So let me show you this. So GLD is what they recommend with these positions. It's got an IV rank of 89. It's extremely high. Let me take my pen out here, and let me go over here to the trader, and let's look at GLD. And what I'm going to do is look at the implied volatility and also look at how it's trading and see if we can get a directional sentiment. So go over here for today, and again, today is July 4th. Last trading day was yesterday, July 3rd. So implied volatility is really high. It actually isn't quite as high as it was on June 25th, but what I'm going to also look at is the stochastic and the RSI. Those are important. So when they both line up, that is usually a good sign that it's confirmed. So for example, let's go back here. And over here, just in May, the stochastic bottomed out. So you had a stochastic, that was giving you a severely oversold signal. It was around 13, is that, yeah, 13.58. And then if you look down here at the RSI was at 40, still pretty low, but without even looking at the stock price up here, I bet you it went up soon after this because it was so oversold. So here we go, 1, 2, 3 days, 4, yep, and then it's on its way back up. That's how I can tell you. So I could go back pretty much any day within the last 5 years, so let's hide that. let's just go to a random day where the RSI and the stochastic lines up, and when you can get an even more pronounced, like if you can get this RSI to dip below the 30 line and the stochastic confirms that, then you know you're good. So, all right, I'm not looking at the stock. I have no idea what the stock did, but I bet you from here it went up. Watch. So let's go up. Boom. Look at that. All right, let's try that again. Any random day within the last 5 years where the RSI and stochastic line up. So, oh yeah, look at these. All right, so if you had the patience, it stayed oversold for quite a while. Gold was just kind of in a slump, and it was down, down, down. So maybe you bought in a few times, here, 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 just while RSI was down. It might take a few weeks, but I bet you it went up after this, even though it looks like it went down over here. So, yep, look at that. Oh man, you would have, if you got in around here, so the close price was 107.93, and you just stayed in, for 2 months, or just kept rolling it. Look at that, hit a close price of 119. So, close of 108 to 119, so $11 increase for, that's about 10% or so, 9%. It's only $133 share price. So that is one thing. So just to recap, because when you're learning things, it's important to recap. I started with the option alpha screener, and that listed the highest implied volatility by rank. So highest, it went to high IV only, implied volatility. And if you just want ETFs, you don't have to worry about earnings, then you could turn on ETFs only. And since I'm OCD's got a little typo, there shouldn't be apostrophe S. Anyways, GLD, GDX would be another one. Another gold market. The implied volatility is 86. So what we're going to do is go over here, GDX, and implied volatility should be off the charts. GDX, implied volatility up here, quite high, and that would allow us to sell, and collect some really good premium. But I don't really see a confirmed trend with the RSI or stochastic. But let's see if we can do that trick I showed you before. Go to any point. So stochastic moves pretty often, but RSI moves less. So here we go. RSI and stochastic are both oversold there, and look what happened. It went way up. And then on the contrary, this is how you know when to get out. All right, so it's up, up, up. Stochastic, it's peaking again. RSI is peaking. This would be the little point. When RSI touched above 70, that is when I would get out. All right, you'd still have a great profit, but it's just too uncertain, because if you tried to eke out a little bit more of a profit, yeah, it closed here at 23.82. If you were, perfect timing, which nobody is, only in hindsight, went up another like $2 or so, but you would have had a nice little profit. You can do this over and over again. It's better to keep what you've earned than risk it all for slightly more gains. Okay, so up, 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 and then when it got peaking, so RSI, stochastic, both pretty high, it just plummeted, and that's the risk you have to take if you want to stay in and try to eke out those minuscule little gains. So let's look again to see if RSI ever dipped below. Let's go a few years ago, so we're making sure we're getting a completely different data what we looked at with the other gold ETF. Totally oversold here, stochastic, RSI, totally oversold. I bet you if you bought in here, if you sold a put, or you bought long shares, or you bought a call, you'd have a nice little profit in the next few days. So this is August 30th, and I think that's 2015. Yeah, 2015. So there, right? And then you get out there. So you could use alarms. Stochastic gives you a faster indication. RSI still had a ways to go, but you can set the app to give you an alert like when the stochastic touches above 80, and then you get out. Or you can do a conditional order where if stochastic closes or if stochastic touches above 80, get me out automatically. All right, so those are 2 stocks based on the implied volatility screener. And I want to show you another way I do this. So I have a watch list, and I like this overbought, oversold. This is a watch list I made on Thinkorswim. It's easy to do. You just can't make the watch list on the app. So once you make the watch list on Thinkorswim, then you can use the app to monitor them. So this is sorted by volume, and this is showing anything that is severely overbought or severely oversold. So like over 70 or below 30 in the RSI. So marker therapeutics. Here we go here, and this is, we want to go to current day. So huge bump up, and I can explain what the Tenkan Kijun, span A and span B are another time. But so both overbought. And in case you forget, what is what, see the 80, overbought is 80. That means this line represents overbought, 80, and then oversold. Oversold is 20, overbought is 80. Those are your kind of benchmarks. And look where it's closing, way above. So what happened last time? It closed above 80. Let's go down and look at stochastic, because again, that's better confirmation. It closes above that less often. Stochastic moves a lot faster, so it gives you earlier indications, but RSI is valuable because it can confirm the stochastic. So look over here, overbought, that usually coincides with a downturn, and yep, look what happened. I could tell you this without even looking at the stock chart. So let's go any random day where RSI and stochastic line up. So I like it. RSI is totally oversold here, and it looks like yep. So it closed here at 3.47, and then once you let stochastic peak right around here or here, so you get a close price of 3.82, and this is on an $8.23 stock. So the point is, I'm back testing it to see if the current sign is a pretty reliable indicator. It is. Implied volatility is pretty low, so this isn't the best for implied volatility, but the other screener is really good for implied volatility. So this trade on the RSI and stochastic using this watch list, this would be good for like long stock, or primarily long stock, because when you're selling options, you want the premium to be high. However, if you wanted to buy the option, what I recommend is buying a put up here, because the put is probably going to be pretty cheap. This has been going up and up and up. So what I'm going to do is I'm going to buy a put, and let's do it for October, and let's buy it at the money. So we're going to do 4.6. Implied volatility is so low, and let's put in a optimistic buy price, and then once implied volatility peaks and it starts to go down, then I'll sell against the put. So let's see if this confirms. It's pretty optimistic, probably not going to get filled, and then we'll do one more even lower, just more optimistic. So we like to ladder down, and so again I put in one at 410, which is a limit price that's very optimistic, and then I copy and paste that over at 3.5. Let's see if that